Hello everyone. Thank you so much for joining in. I think we are good to get started. Now, over the last couple of sessions in financial accounting, I think we started a rerun 3 sessions back, and we have been discussing fundamentals of accounting, where we went over what accounting means essentially, what is the basics of accounting. We went over the journals, the ledgers, the trial balance, and how the financial statements come out of that, along with accounting principles and accounting standards. In the session after that, we understood what are the various standard setting bodies, how is the US GAAP and IFRS set, and what are the qualitative characteristics. In the last session, we discussed balance sheet. Now, there are 5 or 6 core financial statements, right? You have balance sheet, we have statement of income, we have income statement, we have statement of changes in equity, we have statement of comprehensive income, cash flow statement, statement of changes in equity, and notes to accounts. So we have already discussed balance sheet. In today's session, we will discuss in detail income statement and statement of comprehensive income. That's what we'll discuss in detail in today's session completely. Now, when we discussed balance sheet in the last session, we said, right, the balance sheet essentially becomes your core financial statement, one of the core financial statements. And a lot of what we study here will be discussed later, such as cash will be one separate sparring session, accounts receivable will be separate one, notes will be separate, prepayments and accruals will be a different one, investments will be a separate session, investments would be a separate session, PP&E would be separate, intangibles would be separate, deferred taxes would be separate, bonds, equity, AOCI, current liabilities, all of these will become separate sparring sessions. Now we will start with income statement. Now when we start with income statement, it starts with net sales. Now what do I mean by net sales? Net sales is essentially gross sales minus sales returns. Any sales which you made and were returned eventually would be subtracted. So the net sales you made in an accounting period would come here. That's the first line item. Now, what do we consider sales? What is the revenue recognition criteria? Now, earlier there were different revenue recognition criteria for different industries. Now, whether you follow US GAAP or IFRS, there's a 5-step revenue recognition criteria that applies across industries. And it's the same. Now, what are these 5 steps criteria? We'll be discussing revenue recognition in detail in one of the sessions eventually. So we'll have one separate session only on revenue recognition. But just to give you an idea, there are 5 steps based on which you can recognize the revenue. The step 1 is identify the contract with the customer. Step 2, identify the performance obligations. Step 3, determine the transaction price. Step 4, allocate the price to the performance obligation. Step 5, recognize revenue. These are the 5-step process. Now let's take an example and discuss this. Whichever industry you are in, doesn't matter. This is the 5-step revenue recognition criteria that will work. So let's just say you are taking classes from us, right? You're joining Ninja. You are the customer. You join Ninja. And we provide you a service. We provide you a service. Now, what is a service? It's a service contract. It's a service contract. It's not a sale of goods, it's a service contract. What is the performance obligation? On the part of Ninja, we are to provide you access to materials, MCQ, essays or simulations, lectures. That's our performance obligation. The performance obligation on behalf of the customer would be, did you say $67? That's the obligation. Now, we have determined the transaction price. We have determined the transaction price in this case is $67. Now, there is only one performance obligation we have, is to provide you access to all of that. So our performance obligation is only one, that we provide you service, and the entire revenue is allocated to that same performance obligation. Entire revenue is allocated to same performance obligation of 67. Now, the moment we have provided the services for the entire month, we can recognize the revenue. So let's just say if we are starting in April, at the end of April, when you have used all the materials you were allowed access to for a month, and we have satisfied our performance obligation, only then we can recognize this in net sales, only then. Now, if somebody asks for a refund, we'll have to subtract that sales return to get a net sales. Let's take one more example, right? Let's take one more example. Let's just say you go and buy a refrigerator. Now, you also buy an annual maintenance contract along with that. You also buy an annual maintenance contract. So now the contract with the customer is, now the contract which we have, we are selling a refrigerator, but we are also selling an annual maintenance contract where essentially for the next entire year, we'll fix any issues that's there with the refrigerator. We'll take care of it for the maintenance, for repairs, for everything. So the contract essentially is sale of goods and provision of service. There are two aspects to the contract: provision of service. We are selling the refrigerator, that's a sale of goods contract, and we are promising that any repairs, any maintenance will be fixing for it. Now, what are the performance obligations which we have? Sell the goods, provide AMC. Provide AMC. Those are the two performance obligations. Let's say the transaction price in total is $1,200. Now, for sale of goods, we think the transaction price to be allocated is $1,000. For AMC, we have allocated the transaction price of balance $200. Now, we will be recognizing revenue here. So let's just say right on the day of the sale, I received cash of $1,200. Now, refrigerator is sold immediately. It's provided to the customer immediately. So that revenue we can recognize. Sale can be recognized for that $1,000. The balance would be unearned revenue. We haven't earned it yet. We haven't provided the AMC. The AMC will be provided only by the end of the year. So at the end of the year, I will debit unearned revenue and credit sales and recognize the $200 service revenue as well. So the timing of recognition, if you see the timing of the recognition for sale of refrigerator, this is where it's recognized immediately. For AMC, it's recognized after the period has elapsed. Are we clear on how revenue recognition works, everyone? If I can get a response on this. Elisa, yes. Stephanie, yes. So this is the basics of revenue recognition. Any industry we can figure out, any industry. Let's just say if you order something from Amazon, let's just say you order a laptop from Amazon. You purchase a laptop from Amazon. Now, in that case, the contract that is there, the singular contract for sale of goods. Now, identify the performance obligation. Amazon's obligation is to sell the laptop, That's it. The transaction price, let's just say, is $1,000. Now, we will allocate the transaction price. Now, there's only one performance obligation, so the entire price is allocated there. You have to contrast it to the case where we were selling refrigerator along with the AMC. $1,200 were allocated, $1,000 to refrigerator, $200 to AMC. Now, the moment the laptop is sold, revenue